Hello, welcome to the Mutual Fund Show. I'm Neeraj Shah, and over the next 25 minutes, we'll talk about maybe 4 or 5 key aspects that I gleaned from the website of Edelweiss AMC, and I thought I'll cross-question both my guests today on if they believe in a particular topic, why is it that they do think like that, and what are the alternatives thereof. They need no introduction. Radhika Gupta and Trideep Bhattacharya join me. Both of you, thank you so much for taking the time out, and really great having you.
Thanks, Neeraj. Thanks for having me.
Same here.
The pleasure is really ours, and look forward to some learnings over the next 25 minutes. Can I start off with the most obvious question that is probably in the minds of everybody? I saw 3 polls already around Diwali. A couple of people called me up asking me for my responses to polls, and one question that was common was, should we have more exposure to large caps versus mid caps versus small caps? Now, just wondering, Radhika, Pradeep, either of you or both of you can take this. Is it possible to determine what should be the exposures to any of these funds over a 12-month period? And if so, what is your response to that?
So, I can start, and I'm sure Trideep will chime in here. I think he can give a market perspective. But I think from a personal finance perspective, trying to time sectors, trying to time caps, whether it's large cap or mid cap, over any period is difficult. It's difficult for fund managers. Over a 12-month period is incredibly difficult. So that's the short answer. I think there are multiple approaches to this. One is you have some sort of core satellite approach where I say I have some amount of large cap and some amount of mid cap. It could be 60-40. And I don't play around with it too much. 10-12%. Or you let more products like flexi cap do that work for you. But I certainly do think that cap-based timing is extremely difficult, especially over a 12-month period.
I think that's well said. So rather than giving an answer, I'll put a framework in front of investors listening, because that's what will help them decide. And first thing which Radhika said, it depends on the investor objective. What are they trying to do? And I will put 2 or 3 more dimensions to it. Second is over what time frame. So, for instance, if an investor has surplus capital, which is looking to compound over a period of 3 to 5 years, then certainly the more alpha-prone areas would be kind of probably mid-cap or small cap. But having said that, the investors need to have the ability to kind of go through the volatility that once in a while these funds will actually kind of bring along with. Depending on the fund manager, the flexi cap funds actually give the biggest amount of flexibility for the fund manager to navigate around the cap. And as we kind of call it that way. So if you believe in the fund manager, then certainly the flexi cap fund is the way to go about it. And if you're risk averse, then certainly the large cap fund is the one to start with. So on net balance, I think it depends on the investor objective, the time horizon, the alpha expectation that the client has or the investor has over a period of time. All of these should actually go in deciding which way to go about it. But on net balance, I would say go with the fund manager you believe in, the one which has track record, and rather than going by the cap basis.
Okay, useful answers both, and thank you so much for that. Let's move on to the next thing, which I think now over the last 2 years we've spoken about ample number of times on our show. Believe you me, guys, and that is people who have their money in fixed deposits are committing a crime because they are not beating inflation tax adjusted, and they should think of alternatives, whichever shape or form. Now, my question to you is that in the wake of what is perceived to be the next 12 months, where we might see rising rates, is it prudent for somebody to seek a mutual fund alternative to fixed deposits? Why or why not? And what is that alternative? Let's assume that the time horizon is 12 months or maybe 24 months. That's it, not longer.
Okay, so I think, Neeraj, I can take this one. And, I think there are multiple aspects to fixed deposits and the sort of conundrum we have around fixed deposits. One is, of course, it is not a tax-efficient solution. So your mutual fund solutions are tax-efficient. Second is the rate of return, which is agitating more investors because of the way yields have fallen. So there's a return question and there's a tax question. Now, let's keep the return aside. I think if you are a full tax investor, then certainly looking at debt mutual funds makes a lot of sense. Over a 3-year period, it definitely makes a lot of sense. In a less than 3-year period, if you specifically ask that, and I can talk about 3 years in more detail if needed, in a less than 3-year period, I don't think we should try and over optimize. I think, liquid works for very short periods. I would suggest arbitrage funds work very well, especially for this 1 to 2 year period, because where fixed deposits have a marginal rate of taxation, funds over 1 year have a 10% rate of taxation. So when I have money, I have money that I want to spend on a house construction that I might use in 6 months, 12 months, especially 1.5 years, it's this vague pool of money. I tend to park it in things like arbitrage funds. That works really well. I also think we should not obsess with over optimizing 1 year money. The delta between 3 and 4 and 5, because I feel when interest rates are really low, we try to stretch the boundaries of credit and duration and what we are comfortable with and get into trouble. The second thing I would recommend, which is if you are a fixed deposit investor who wants to take a tad bit more risk and not equity risk or balanced advantage fund risk, and you're trying to do a 2-year solution, you can look at a category called equity savings. That's 30% equity, 70% fixed income with equity taxation. Perhaps you can move that into equity later. Perhaps you can keep it there. It's a starter way. So arbitrage for the very conservative, equity savings for the guy who's looking at 18 to 24 months out.
And the possibly rising interest rates will not have a large dampening effect on both of these options, you say?
So arbitrage, definitely not. Actually, neither will, because in arbitrage, you are holding cash futures arbitrage and 3-month fixed income. So this is one category that is not duration or credit sensitive. Equity savings is 1/3 equity, 1/3 short-term debt, and 1/3 arbitrage. So again, they're reasonably insulated.
Okay. Very cool. Thanks for that, Radhika. Well, viewers, I hope that answers. So many of you have this question, and I think this is probably the most practical, simple answer that we've gotten, and to the point, so to say. So lovely. Remember, viewers, Radhika mentioned about more than 3 years. We're not including it here, but more than 3 years, there is such a distinct tax advantage that you don't even have to think of it. Okay, fair call. Trideep, I guess this one is coming your way because, again, when I look at polls, when I hear a lot of experts who come on some of the shows that I do, everybody's believing that from a short-term perspective, BFSI or banking is probably that space which will do very well. From a 5-year perspective, Indian technology is probably going to get the best bang for the buck. And my question was more about whether thematic funds are the ideal bet or no. But I would urge you to probably tell me that within thematic funds, from a 1-year perspective, are BFSI funds great to have? And from a 5-year perspective, are technology funds great to have or no?
The answer to this is the classic English answer, which is it depends. But let me elaborate on what I am trying to kind of say in this. On the topic of sectoral funds, I think the first thing that one needs to calibrate is the risk appetite. If you go, let's say, 6 months ago, or even 9 months ago, the consumer discretionary funds were the ones in favor. Now, obviously, with the 2 companies reporting and the credit growth improving, obviously the banking sector is in vogue, if I may use that term, and hence people are looking to kind of take exposure to that. Of course, technology, particularly given the new age IPOs that you're coming through, that's where it is coming from. Now, if you put that in perspective, ideally, what I'm trying to highlight is different times, different sectors coming to vogue. An investor who is looking to put money into sectoral funds certainly needs to have the patience and the wherewithal and the time to switch out at the right minute in case he wants to kind of move on to the next sector in vogue. Over a period of time. So certainly, should one invest in banking sector in the short term? I can't make a recommendation on your television, but it would seem from the factual data from the companies that have reported so far that the credit growth is picking up, and we are in the early stages of the economic cycle. If that were to come through, then banking sector is certainly one that should kind of make hay in the sun. But hey, there are other ways to do the same, like for instance, capital goods company. Like for instance, early cycle in the consumer discretionary deep end as well. So in other words, while sectoral funds is one way to kind of slice the overall pie, there are many other ways to play this. But one thing that I would say, certainly given where we are in the economic cycle, that a fund with an economic bent towards it, in other words, which is oriented towards economically sensitive sectors, is certainly the one to go about it. Whether it's banking sector or others, that I leave the choice with regards to the investor. Tech funds, it's a hot topic of debate. I think old and new investors, the new stage of IPOs which have come about, it has questioned our investment frameworks to the core. Some of them like Paytm, etc., which are kind of hitting the market without taking a view one way or another, is certainly putting the question to all of us that are these businesses to be there for long term, or are these fads? I would say some of them certainly will be around. The marketplace of contention is certainly changing from brick and mortar to more digital, and the last 2 years has certainly gone in that direction. So clearly, over a period of time, the right selection of tech investments is one way, certainly way to invest over the medium term. But having said that, again, this is an area which is fraught with disasters. For one Amazon which has been successful, there have been multiple Yahoos and other names which have kind of bitten the dust. So which one? Who is running it? How it is governed? What are the investment framework that everyone is using? Is certainly the key question to answer before we put money to work. But in principle, why not? Over the 5 years horizon, some of these tech companies will certainly be interesting investment opportunities.
Well, Radhika, and that brings me to a related question, if you will. Though I was actually asking maybe more from a how would Indian IT firms' portfolio exposure be? But you've been a vocal, and please correct me if I'm wrong, but you've been vocal about the need for having international exposure. And therefore, my question to you is, if somebody wants to go ahead, have exposure to not just tech companies, but international companies, what's the ideal mix, Radhika, if you will? And maybe what's the ideal mix at the start versus, let's say, as it builds up? Does it reach a particular level where it's ideal to have that kind of a mix?
Sure. So I'll share my thoughts here. Actually, our whole house, all of us, me, Trideep, everyone will tell you that international investing is important. Now, let's just talk about stages. As an Indian investor, clearly, Neeraj, international investing is not the first thing you do. So you do your domestic equity first, because I have people who come to me, I have 22-year-old kids who come to me and say, I want to do a US tech fund as my first investment. And I tell them, hold on, why don't you start with India, understand equity first, and then jump into another market. That said, if you're done with this, I think international is an important part of your portfolio. What percentage, again, depends, but can start at 5 and go to 15 to 20. It shouldn't be 1-2%. It has to be meaningful. In my view, you should start with developed markets exposure first. And you can do developed markets a couple of ways. So there are US funds out there. If you want to pick certain themes in developed markets, for instance, then, you can say that I don't want exposure to US financials, etc., because I already have that in India. But some of the disruptive tech, I don't get that in the Indian context. I get largely IT services. I can, do funds that are focused on US tech or, any of those indices. So lots of those options are out there. I think once you are done with that, a second category to look at is an emerging markets fund. Outside of India, of course, the most major emerging market is China. Now, you can access this either via an emerging markets fund or a dedicated China fund, because that's really the biggest market. But the thesis being that India is not the only emerging market that grows. There's Bangladesh, there's Vietnam, there's China, etc., etc. And you can split the allocation. So today, for instance, in my portfolio, I have a US fund and I have an emerging fund as my international exposure. And that's how I think I would build up. And I would caution people, if they're doing this, please have a 5-year horizon. International investing gets very exciting once the returns look good, and then people get suddenly disappointed because they come in basis past returns. It's equity. You've got to look at it for 5 years.
Well said, and thanks for that advice as well, Radhika. Much appreciated. The last couple of questions, and I saved the best one for last, because that's something that I wanted to ask. It is not out of data or matter that you put on the website. But before that, your thoughts, both of you, on the funds of funds options, because I think your website says that you call it the investment food court. Can both of you talk about this?
So I think if you're looking at, and then, Trideep, please add, I think if you're looking at fund of funds that invest overseas, they are a great way. I mean, there are two ways to invest overseas. Either the asset manager in India directly manufactures overseas and picks stock overseas. He could do it actively, he could do it passively. The fund of funds option is basically us partnering with someone like a JP Morgan to do this overseas. I think it is a very good option because as Indian asset management companies, while we can focus on a certain set of global companies, a market like China, for instance, we benefit from the dedicated asset management expertise of a guy like JP Morgan, which has a team present locally in China. So I think fund of funds work really, really well because they give you access to an international fund manager sitting in India. And I must also correct, people sometimes think that fund of funds have a double layer of cost. Under today's SEBI regulations, the total cost of an FOF is 2.25% at max, which is the same as a domestic equity fund. Global fees, India fees, everything put together. So it is not more expensive. And I just thought I'd add that. Trideep?
I would actually say that, I would have, overall, I would say that echo what Warren Buffett said, that overall, one has to kind of remain within the circle of competence. And in that context, if we have a bouquet of options to invest, wherein individual circle of competences, whether it's basically emerging markets or developed markets or a particular market like China, Thailand, etc., is coming about, then certainly from a diversification or from a risk return perspective, investor is better placed to kind of invest in such an option because he gets the best of both the worlds. Otherwise, trying to have a Dravid bat like a Sehwag or other way around can get into a disaster. So certainly a fund of funds works in diverse, particularly when we are dealing with diverse asset classes like either multiple asset classes like equity, debt, currency, this, that, the other, or for that matter, international investment.
Right, Radhika, sorry, so can you tell me, Radhika, what was this about? I mean, do people say that the expense ratios go up much more than 2.5%?
So, the funny thing is, I get two queries. If I got a coin for every time I got queries on international fund expenses, I would be a very, very rich person by now. Because there are two layers of costs in an international fund. So let's just take this JP Morgan example. There's a fee that JP Morgan charges, and there's a fee that Edelweiss charges, right? Now, people sometimes on some websites, like our AMC website discloses both fees. Sometimes channel partners disclose one fee. So people have no idea what it is. And they sometimes assume that actually there's a 2% fee that JP is charging, a 1% fee that we are charging, and the total fee is 3%, etc. So there is a big myth going around that international funds through the fund of fund route have a double layer of fees. A few years ago, SEBI had capped the total fees as the same as a domestic equity fund. So between me and JP Morgan, however I split it is my problem. I can't charge the consumer more. In fact, Neeraj, because of this is an interesting stat. My US tech fund is much more expensive for an American retail investor than it is for an Indian retail investor because of SEBI's caps.
Oh, is that so? Wow.
Absolutely. Because we don't have entry loads. We have a 2.25 capped fee, and those markets don't.
Wow. Okay. But hey, great for the consumer, right? Great for
very good for the consumer.
Yeah. So that's awesome. I'm not complaining. Okay. Now, one last thing, and this is a bit of a pickle, but I asked this to you, Radhika, because I have known you to call a spade, and which is why it was apt to ask you. There have been a bunch of NFOs that have come off late, right? The only difference is that in all of the shows that I've done, which required the advisor who comes in after the CEO or the CIO has gone away talking about the NFO, says that why do you want to invest in an NFO? Because there are established funds out there. So let the fund develop a track record. And then you go out and invest in the NFO. Not a single advisor thus far has told me, no, go out and put money in the NFO. Now, sure, I can understand if there's an NFO is a difference. Like maybe, I think you guys maybe came out with that IPO product, if I'm not wrong. Yeah. Or somebody else came up with a very different product, which is difficult in these days and times because of SEBI's regulations. But otherwise, why should anybody go for an NFO?
Okay, so I can see Trideep and you smiling there as you throw me the sort of Yorker here, but I will make an attempt to answer it. So Firstly, I have no problem with NFOs. I think you have to separate two things. I'm going to give you a restaurant analogy. If I were the owner of a multiple, food business, and I have an Indian and Chinese restaurant, and in my suite, I don't have a Mexican restaurant, as an asset management company or as a food owner, I am more than entitled to open a Mexican restaurant. Right? It's my business, right? I'm entitled to do that. And hopefully I'll run a good Mexican restaurant. And you as Neeraj Shah, who is a consumer, just because every restaurant chain is launching a new restaurant and cuisine does not have to go eat at it. You will eat the things that suit your diet to the quantity you want. If there are 100 restaurants debuting in Bombay, you will not eat at 100 of them. You will go to a restaurant if it offers something new. And I think that's the same thing. AMCs will launch NFOs because they are going to open their basket. If I don't have a mid-cap fund in my basket, I probably want to launch one because I think I can do well in the mid-cap category. So there's nothing wrong with an AMC launching an NFO as long as they're qualified. A consumer has to be extremely discerning in how they think about investing in an NFO. There are NFOs that I think are very, very unique. You mentioned the IPO fund. I think Bharat Bond and the debt passives NFOs were very, very new to the market. They're doing a larger mid-cap fund, index fund NFO, which is the first time it's coming to market. There are first-time products that come to market, which are genuinely new, and you can consider them. There are things that are, there's a 50th mid-cap fund launching when they're 45. You may want to give it time. So I think my point is that an AMC will do what an AMC has to do as a business. You have to do what you have to do as a consumer. Ask yourself, am I getting something new here? Is it fitting in my diet in some way? And I would also say something, about calling a spade a spade. No investment opportunity is time bound in our markets, right? There's no 2-week investment opportunity. If it's a good investment opportunity, it's going to last some time. So the worst thing that you can do, in my view, is take an investment decision in a rush. And I think the market will proliferate with more products. There are going to be lots of new asset management companies coming out. There are going to be lots of products. I mean, I probably have 3 NFOs in the next 2 months, and I'll come on your channel and talk about them. And hopefully they're all new. I think they all are. But, I'll also have lots of new NFOs coming to market. But you as a consumer have to be a lot more discerning.
Trideep, does she dig out the Yorkers in your group meetings also with so much aplomb?
I have it since I've joined recently. Not many so far. So far, I've been able to handle them. But I'm careful, particularly after this answer.
I'm just saying Radhika did a great job. No, but honestly, the question was only that in case of NFOs which are not necessarily unique, and I'm glad Radhika said that because there are 2-3 implications of this. I mean, I don't know in which way Radhika said it, but if she's meaning that there is no need to rush, maybe the person doesn't need to subscribe it while the NFO period is on. Do it after the NFO is launched and it's up and running. And
good decisions can never be made in a rush. So if you understand it during the NFO, please do it by all means. I have nothing against NFOs, but no investment decision, listed equity, debt, private, nothing in life should be done in a rush. And, the last thing I'd say on this, I have been in Delhi for some time looking at family and friends portfolios. I see portfolios with 150 schemes. That's not good for anybody.
Oh, okay. Yeah, and I actually, we've spoken about this in the past as well, Radhika, about the number of schemes that people have and how maybe it is prudent to maybe bring them down. But great. Radhika, Trideep, thank you so much, both of you, for taking the time out. And from all of us out here, to you and yours, happy festivities, great Diwali, and a prosperous New Year.
Happy festivities.
Same to you and your viewers.
Yeah, thank you so much. And viewers, thanks for tuning in to this edition of the Mutual Fund Show.